Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Synchronized business cycles. Again, we just didn't have that. Now, with the globalization of the economy in general, we start to see business cycles to be more and more synchronized. But again, the common currency really was based on really one economy as the driver, and it was Germany. So all the monetary policy, the one size monetary policy fits all, was always targeted at Germany. And if other economies were out of sync with Germany's need on interest rates, then so be it. So we never really had that. So that was another problem. And harmonized fiscal discipline. Again, there was an attempt, people signed treaties, but there was no real enforcement of this. As we see now, all of a sudden people are waking to the fact that budget deficits are blowing out and all kinds of other hidden problems in these countries. Again, there was no mechanism to really drive that other than just, hey, sign the treaty type of thing. Things that they would have needed are, a treasury, common treasury across these various countries, and really common cross-border banking regulation. When the credit crunch hit, we saw how the incredible disunity among the various countries that are part of the monetary union in their own banking regulations, which again created more chaos and more trouble. So these things were, I think, seen by a lot of people beforehand, and we were just looking for the test, and we got the test in terms of the credit crunch, which kind of brought all these warts to the surface, so to speak. And these are things that are obviously still with them, and these are things that now have become that are creating more tensions, and they have less chance, I think, of achieving these things going forward. This is a quote here from Milton Friedman, who's one of our favorites of all time. And he said this back in 1999. He never thought the euro would hold together, and this was kind of a very prescient comment. He talked about, as they add more and more countries and more layers of regulation, more and more susceptible to a shock in the system. And he thought the internal contradictions, this whole idea of the contradictions being that the euro was an artificial construct to begin with, the idea that you have one monetary policy fits all, the idea that all the countries should be able to borrow at low German interest rates never made any sense because the other countries were much more risky than Germany was. All those contradictions, he thought sooner or later the global economy hits a real bump. And that real bump didn't come really until the credit crunch of 2007, 2008. That was the bump, and the euro has really failed the test, and we'll see how badly it fails. This came yesterday from Ambrose Evans Pritchard, who writes for The Telegraph, and has done a pretty good job of covering this whole euro mess. I think he's done as good a job as anybody out there on a regular basis of late. And he talks about the big problem now is Spain, and the reason Spain is such a more dangerous creature here than even Greece is because of the size of Spain and the depth of core problems within Spain are as bad as Greece or worse. And he thinks that they're in a case now where he just says only two things can happen. Either Germany continues to tolerate this and continues to be the paymaster and hooks the German taxpayers to infinitum against this ideal of the European Monetary Union, or one of these countries, Spain, which he thinks is going to be the one that may be forced out of the EMU. There's already a lot of talk of Greece leaving and their politicians talking about this. But there's turmoil in all these countries now, political turmoil across the board. Merkel is tied her wagon to the euro and is probably, and we said this probably about 6 or 8 months ago, we think she'll commit political suicide if she ties her wagon to the euro, and she seems to be doing that. The president of Germany just quit her administration, so to speak, and it looks like he may take a run at her. And and we're seeing political problems, obviously, in Greece. A lot of the key administration in Greece has already resigned, and that government's in complete turmoil. Spain is next on the list, and the turmoil is starting in a very big way in Spain. We're starting to see it in Italy, too. All of these players within these countries were promised by their leaders that everything's going to be hunky-dory when they get part of the European Monetary Union, and they've lived high on the hog because of the credit created by being able to borrow at German interest rates. But the market sooner or later has a way of catching up, and the market is catching up, and that goes to Friedman's point of the real bump. So those are really some of the core problems, or at least, I guess, the major themes. If you step back even from the numbers and look at it and say this system was flawed, really, from day one, really. The next point that Pritchard makes in here is a catastrophic chain reaction throughout North Europe's banking system. I was asked by a friend of mine a couple weeks ago, what do you think of, are the European banks a good buy in here, given how far they've fallen? Well, I said, I guess it depends on your time frame. If we get a bounce in the stock market near term and we get some euphoria in here the next few weeks, maybe European banks bounce. They did a little bit. But the reality is all of this stuff going on with Greece and all of this stuff going on at the G20 even a year and a half ago was about saving the European banking system. All of this stuff is the exposure to the European banking system is huge. I don't think we even know it. I'll give you some numbers that I think are conservative that the European Central Bank came out and talked about just recently, but they are conservative. The reason the European banking system problems are so important is because Europe generates a ton of money relative to their GDP from their banking and financial system compared to the U.S., for example, and other countries. It's a huge driver, and it's going to be a huge chain reaction because not only is it the core countries of Europe that are exposed, if the European banking system gets into trouble, and I'll talk about this, the contagion problem to Europe, to Eastern and Central Europe becomes really dire. Their funds just evaporate immediately, and that just creates a whole nother set of systemic risk for the global economy. But, I think you hit it right on the money here. This really is ultimately about the European banking system and trying to save it, and that's really why they agreed to let the IMF come in. The IMF puts U.S. taxpayers on the hook for a lot of this and starts to create more and more bailout money, so the European banking system can start to unload some more of that bad paper that it's already starting to unload in a very, very big way on the balance sheet of the European Central Bank, since the European Central Bank has basically opened the floodgates and said we're going to have quantitative easing, even though Trichet continues to say it's not really quantitative easing, but in fact it sure is, and there's no other way to describe it. Let me go through this chart because this is an important chart, and I think it says it all. This chart shows the spread between Spanish 10-year bonds against the German 10-year bonds. And as I said, Germany is the core here. I mean, they're the solid player in all of this. And so everything is measured against them as the, fiscally secure country, so to speak, even though they have their own banking system problems. That's kind of another dirty little secret that isn't hitting the press. They have some real problems in their own banking system that don't look pretty, but they pale in comparison to the others, and that's why people are not talking about it. But anyway, Germany as the Bund is the core quality benchmark is which we compare against. And this shows of late, you can see here, the point I wanted to make in here, the introduction to the euro is right in here. And you notice the spread, 4.5%, 5%, 500 basis point spread in here for Spanish bonds against German bonds before the euro introduction. That was probably more of a proper market pricing of Spanish versus German bonds. German's fiscally responsible, Spain not. Of course, the introduction of the euro, and it creates this artificialness for a very long time, allowing Spain to borrow at close to German interest rates.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.